Okay, hi everyone. This is going to be the first lecture for Chapter 9. Going to be talking about transfer pricing. So, transfer pricing refers to the determination of the price at which transactions between related parties will be carried out. Transfers between related parties are known as intercompany transactions and represent a significant portion of international trade. So, typically, what you might see, right? Large multinational corporation has a bunch of subsidiaries underneath it, right? Maybe we have subsidiary A and subsidiary B. Imagine that A wants to sell a product or service to B. The question becomes, at what price should we set this transaction? Now, that's the whole point and focus of transfer pricing. These things can happen from sub to parent, parent to sub, or sub to sub. And there's two big factors that come into play when we set these prices. Transfer pricing laws, right? Like what does the IRS tell us we have to do? And then we have internal management objectives, right? One being cost minimization. For example, imagine A and B want to sell items from A to B, and one of them is in a low tax jurisdiction, whereas another one is in a high tax jurisdiction. In that situation, we as management may step in and set the price in such a way where we shift the profit from the high tax jurisdiction to the low tax jurisdiction. However, when you start messing with the numbers, right, and the sales prices, we then start to affect performance evaluation. We'll look and see this, but essentially what might happen is that a division or a subsidiary may not look as good as it really is on paper. So it may understate profits just to get the lower tax burden, but that's not really reflective of their true profits. Have to be cognizant of those things. So businesses are often organized by division. That is, you can have profit centers or investment centers, and they normally adopt a framework of decentralization. That is to say, top managers are going to delegate authority and responsibility to division managers. Hey, we're the parent, you're the subs, you guys just run independently, and we'll make sure that everything flows efficiently and effectively. Now, we have to be aware of goal congruence here. That is to say, something that might be in the best interest of the company as a whole may not be in the best interest of a particular division. So transfer pricing, as I have, is of importance for divisions, as intercompany transactions provide the revenue for the selling department and the cost for the buying department, which will ultimately become an expense as cost of goods sold. So the idea here is if A sells to B and we're setting the prices, this is important because if we look at the income statement of A, it's going to show their revenue. And if we look at the income statement of B, this is going to show their expense, ultimately, if they sell the item. So with regard to transfer pricing, there's kind of three general approaches that you could take on it. You could look and use a cost-based transfer pricing system. Issue with this is what costs are we using, right? We may say, A, you're selling to B, you need to set the price at cost. Well, is this variable cost? Is it fixed costs? Is it both? Are we basing this on actual or budgeted? What do you mean by cost? Alternatively, we could use market-based transfer pricing. Basically, hey, what would this be charged? What would the price be if it was sold to an unrelated customer? Or if we just looked at the open market? Problem with this is if you have really specialized goods or services, maybe there isn't an open market available. A third approach you could take is negotiated transfer pricing. Hey, A and B, you want to sell items to each other. That's great. You privately negotiate, figure out what the price will be. Problem with this is efficiency, right? If every time we have subsidiaries selling goods and services to each other and we have to build in time to negotiate, that's not really an efficient way of running a business. Maybe it's simpler and more effective to just use cost or market. So transfer pricing, as we've talked about, comes into play with performance evaluation. So to fairly evaluate performance of a division, transfer prices have to be set at a price acceptable to both parties. An acceptable price is one that's reasonable and based on objective standards, looking to the market. So let's look at two examples here. Example one, we have a parent company and two subsidiaries, A and B. Looks like A makes TVs and B is a retailer. And A wants to sell a TV to B, so B can ultimately sell it in their store. So A says, hey, we can sell these TVs to unrelated third parties for like $127. B says, we can buy these TVs from unrelated third parties for like $132. So if you were to set a transfer price here, a reasonable price, and that is to say an acceptable price, it would be somewhere in between those two thresholds. Now let's say that they agreed upon $130 for the sales price. In that case, both divisions, A and B, are ultimately going to show $23 in profit. So they're like equally good, right? Both, here you go, you get an A. Example 2 in distinction changes the facts. So they're saying company A here is based in Taiwan, which has a 17% tax rate, and company B is based in the USA, which has a 21% tax rate. Now, overall, there's $60 of profits to split between this transaction, right? And what the parent company does is they come in and they say, hey, we want to take advantage of this low tax rate, this 17% tax rate in Taiwan, instead of paying 21% in the US. So we're going to come in and we're going to force a transfer price of $150. Now, this makes company A really happy, right? Because check it out. If we do that, they're ultimately going to have $41 in profit, but company B is going to be unhappy, right? They only have like $8 in profit. So if you're in company B, right, this isn't looking good for your balance sheet. This was kind of involuntary, right? The parent company forced us to do it this way. And if we need resources, we're growing or this or that is happening, we're not really going to be in the best interest or in the best light with management just based off these numbers. We're only showing $8. So what was going on there in the second example was basically showing cost minimization. That is to say, the parent company wanted to lower costs by lowering taxes. This is great, right? But as we have seen, it can affect performance evaluation. So there's a tension between evaluating subsidiaries or divisions as well as cost minimization. One thing you can do to kind of get the best of both worlds here is dual pricing. That is to say, set one price for your books and tax, take advantage of that low tax rate in Taiwan, and then for purposes of performance evaluation, use a different price, maybe use a market price, right? So then we can get a fair evaluation of how company B is really doing. So when we looked at the last example, right, the cost avoidance was income tax. There's other taxes and items that can come into play that affect cost minimization. So withholding tax, how would that affect this transaction? Tariffs, right? Do we have to pay a tariff in this sale? Currency devaluation, like hedging, speculation. If we speculate, for example, foreign currency will devalue in the future, maybe we want to move more of that foreign currency out of the country now before the devaluation occurs. Improvement of foreign operations to gain a competitive position. Maybe we see a market that's up and coming and we really want to emphasize that division, so we could set the prices to reflect and help that end. So this is just giving you some general rules, right, in light of those variables. So if the cost minimization goal is to minimize taxes, income taxes, then for purposes of transferring to a country with a higher tax rate, you want to set a higher price. For purposes of transferring to a country with a lower tax rate, set a lower price. These are the transfer pricing rules with regard to each of those situations. So in practice, right, they basically use cost-based methods and market-based methods. It's evenly split between businesses. Cost is going to provide a little bit more flexibility because we have that ambiguity with what do you mean by cost. But there are kind of things that give rise to preferencing one over another. So why may you favor cost-based method? Well, if there's differences in income taxes, if we want to minimize import duties, looking at foreign exchange risk, if there's restrictions on profit repatriation, in all of those situations, cost-based method may be a better selection. Whereas in distinction, right, if it's in the interests of local partners and we want to have a good relationship with the government, market-based method may be more appropriate then. So I guess the setup with all of this is governments are not stupid. That is to say, they know that businesses can do this, right? So tax authorities are aware of multinational corporation manipulation of transfer prices to avoid paying taxes and import duties. For this reason, most countries have transfer pricing laws. The issue becomes, and we'll see this later on, is when you're looking at like different countries, they can conflict, right? Creating the possibility of double taxation when a price is accepted by one country, but disallowed by another. We'll look at this later on. Now the OECD, right? They have model rules regarding transfer prices. If they're afraid of and want to stop base erosion and people not paying taxes, transfer prices are important to them. Generally, they're going to say, hey, you should use an arm's length price for tax purposes. And then they also have a bunch of details regarding how you should disclose this and put these items on your financial statements and your tax returns. So in the US, right, with regard to transfer pricing rules in tangible property, so A wants to sell tangible property to B, it's an intercompany transaction. It should be set, and the IRS says, at an arm's length price. You have to do it that way. And under IRC Section 482, they have the ability to come in and adjust the prices to reflect this fact. So if you don't use an arm's length price, they can come in and say, this is an arm's length price. There are various methods the IRS lets you use to establish an arm's length price. And it really depends on the facts and circumstances as to which one you're going to pick. That is to say, we're trying to establish an arm's length price for the sale of tangible property. The IRS gives you 5 methods, right? This comparable uncontrolled price method, the CUP method, the resale method, the cost plus method, the comparable profits method, and the profit split method. Now, all of these, right, are different methods that are permissible that you can use. One of the things that's like kind of important to note here is that they're not going to give you the same price, right? They may give you a range of acceptable prices. So maybe if you use this, the price would be $9. That you use 10. That you use 11. As long as it's within reason, right? It's like a reasonable amount within a range. That's okay that it's different. Right? If this was 9, this was 10, this was 11, and then you use this method and you charge 40, that's not going to be reasonable. But there is a reasonable range here. And if the IRS were to audit you and reassess, basically readjust these prices to what they should be, an arm's length amount, what will happen is the taxpayer will have 30 days from the request to basically provide documentation for why they selected these prices. If ultimately the IRS is going to reassess the price, you could get hit not only with the additional tax caused by the reassessment, but also penalties and interest. So we're going to look at these 5 methods each individually. So talking about sale of tangible property, have to set it at an arm's length price, 5 ways to do so. One of 5 is called the comparable uncontrolled price method, the CUP method. And as I have here, this is generally considered the most reliable measure of an arm's length price. What we're really going to do here is look for a comparable uncontrolled transaction, see if this exists. For example, if a US parent sells goods to a foreign sub, we could determine the price by 1, looking at the parent sales of goods to unrelated parties, or 2, looking at foreign subs' purchases of the good from an unrelated external party, or 3, looking at the sales of the good between two unrelated parties. So basically looking internal and external to us for a comparable transaction. Now, comparable, right, it has to be comparable. So there's many considerations here, right? Like, what is the product? What are the contract terms? What type of market are we in? When did the transaction happen? Were there foreign currency risks that happen? So just because it's the sale of a good and it's the same type of good, it doesn't mean the facts and circumstances are such that it is comparable. It truly has to, be comparable. It has to be a similar setup. 2 here, right? The second way we could establish an arm's length price for the sale of tangible property. We could use the resale price method. So basically what happens here is this method determines the price by subtracting an appropriate gross profit from the price at which the controlled buyer resells the property. Basically, this method here is best used when the buyer reseller, so A sells to B and then B sells it, we're talking about B here, when they are merely a distributor of finished goods. They don't really add any value to this, they just buy it and then sell it. So to use this method, we have to be aware of the final selling price here and assign an appropriate gross profit for the reseller. What that means is when B sells it, what's that price? We need to know that price. And once we do know it, then we can, and we take into account an appropriate gross profit, we can back into the transfer price. For example, let's say a US parent sells goods to a foreign sub. The foreign sub sells the goods to external parties for $50. Normally they have a gross profit on this type of sale of 25%, the foreign sub. Right, so what we do here is we take the final selling price, back out of that an appropriate gross profit. That will give us our transfer price. So A sells to B, we look to B here, what they sell it for, back into the transfer price. Third method here for establishing a arm's length price for the sale of tangible property would be the cost plus method. So this method adds an appropriate gross profit to the cost of producing a product to establish an arm's length price. It's appropriate and best used when the buyer, B, does more than just distribute the goods. So essentially what we're doing here, instead of looking at B's selling price, we're looking at, in this case, A's cost. And then we're building into that an appropriate gross profit markup. So for example here, let's say parent sells component to foreign sub that costs $4. Foreign sub combines the component with other parts and resells the new good. So they do more than just resell it. They add some value to it. The normal gross profit markup on this new good to unrelated buyers is 25%. So in this case, right, we're going to have the $4 parent cost plus the associated markup there, the 25%, that will give us our transfer price. So we're looking at cost plus a gross profit margin to it. Fourth method, comparable profits method. So what does this say? So this method is based on the theory that similarly situated taxpayers will tend to earn similar returns over a given period. In this method, one of the two parties, A or B, right, in a related party transaction is examined. Afterward, an arm's length price is determined by referring to an arm's length transaction earned by an uncontrolled taxpayer on comparable uncontrolled sales in light of operating ratios. Let's see what that means through use of an example here. So for example, we have a parent who sells a good to a foreign sub. Foreign sub then resells it in country X. So looking at the foreign subs here, we have a foreign sub that has $1 million in sales and $200K in operating expenses. Over the last few years, comparable entities to this foreign sub and country X have an operating profit of 5%. Thus, what we need to do here is we have to set the price in such a way that our foreign sub also gets that 5% operating profit. That is to say, in this case, an operating profit of $50,000, 5% of the million. So to achieve this, right, our cost of goods sold and therefore our transfer price has to be $750K. So in other words, we got to get them to the operating profit we want to. In order to do that, we have to figure out our cost of goods sold, which sets the transfer price. Fifth here, right, it's called the profit split method. So the idea with this method views the buyer and seller as one economic unit. Total profit from the unit from sales to uncontrolled parties is allocated to the members of the unit based on their relative contributions in earning the profit. So two versions here, comparable split method and residual profit split method. Basically what happens here, the profit is determined by reference to the operating profit by each party in a comparable uncontrolled transaction under A. Under B, as I have here, right, this is used when controlled parties possess intangible assets that allow them to generate profits in excess of what is earned in otherwise comparable uncontrolled transaction. The combined profit is allocated to each party to provide a market return for its routine contributions to the relevant business activity. Basically, what's going on here with the profit split method, we're basically looking at A and B as one, and then we're allocating the profit that we expect from this between them based on their relative contributions. So, 5 methods for setting the transfer price. For tangible property, we have the cup method, we have the resale method, we have the cost method, the comparable profits method, and the profit split method. This one right here, we're looking internal and external to the organization. This one right here, we're looking really at the seller B. This one right here, we're looking at the cost, what it costs to A, and all of this being a transaction from A to B. Comparable profits, we're looking to what we would expect B to have comparable profits of to similarly situated entities in that country. And then profit split method is really viewing them as a single entity and dividing the profit in such a way where it's based on contribution. So now we're going to talk a little bit about intangible property, right? So we talked about the sale of tangible property between related parties. How do we do it for intangible property, specifically licenses? So things like patents, copyrights, trademarks, franchises. Let's say A has a copyright that they really like and it's very valuable. They want to license this to B so that B can use it in their business. How do we set the price on that? Well, in this license, the IRS would come in and say, hey, here's 3 different methods. And they're similar to the tangible property. We have a comparable uncontrolled transaction method, basically what the parent would charge an unrelated party for the license. We have a comparable profits method. Basically, we would look to the profit measure of one of the parties if the cost of goods sold were to achieve this outcome. And then we have a profit split method that uses a form of the residual profit split method. So similar ideas here, looking to what would be a reasonable price if we were to license property, intangibles between business entities. Next thing here, right? Intercompany loans. What happens if A wanted to loan money to B, right? How do we set an interest rate on this? So when one member of a controlled group makes a loan to another member of the group, the IRS requires an arm's length rate of interest to be charged because in this case, right, somebody's getting interest expense, which is going to reduce taxable income. When we're looking and trying to determine an appropriate rate of interest, this is really based on facts and circumstances. What is the prevailing interest rate at the time, as well as what's the credit standing of the borrower? Is this a really reliable borrower, or do they have a bad credit history? One of the things here, if you were setting an interest price here on a loan, is that the IRS has a safe harbor, which basically says if a member making a loan not normally engaged in lending, then the stated interest rate controls, hey, that's a good, acceptable interest rate, as long as it's greater than the applicable federal rate, but less than 130% of the applicable federal rate. So as long as you're basically within the realm of reason, right, what's going on the open market with the applicable federal rate, we're going to say that that's an okay interest rate. Next, intercompany services, right? How do we figure out the prices here? If A is going to provide services to B, what do we charge them? So as I have here, when one member of a controlled group provides services to another member, the IRS requires the purchaser of the services to pay an arm's length price for the service provider. The charged amount should include both the direct and indirect costs, and if the service is an integral part of the business function of the service provider, the price must include a normal profit. Otherwise, you don't have to include a profit component. So let's look at an example here with a US parent who's an engineering company. They want to send their engineer team in to fix a foreign subsidiary's building. So in this case, we have to include, we're trying to say, what should we charge our subsidiary for providing these engineering services? We'd have to include in that cost, direct costs such as travel, materials, what we're paying our employees, indirect costs like manufacturing overhead, and clearly, we're an engineering company, right? This is like an integral function of what we're doing. So we have to build in an appropriate profit into the price that we charge the subsidiary. Next, right, we're going to talk a little bit about this idea of correlative relief. So if the IRS adjusts a transfer price in the US, there's no guarantee the foreign country is also going to adjust that price to provide correlative relief. So, for example, assume a U.S. parent sells goods costing $10 to a foreign sub for $12. The foreign sub then sells the product for $20 with a 15% tax rate. Okay, so in this situation, this is what we're trying to do, right? We're trying to set the price for $12, and in this setup, we're going to have basically 42 cents of tax here and $1.20 in tax here. However, say what happens is this whole transaction right here gets audited by the IRS, and they come in the U.S. And come in and say an acceptable transfer price. You can't use 12. You have to use 15, right? So basically, what's going to happen here is you've already reported this in country B for that amount. You can't like change that now after the fact. So you're still stuck with this $1.20 over there in tax, but now you have an increase in tax here, to 105, from 42 cents to 105. So the idea with this is you better set these prices up accurately up front, not only for fear that you're going to get adjusted right here. That's one problem with it. But the other problem is if they adjust you here negatively, there's no guarantee the other country is going to come in and adjust you favorably. It could just stand the way it is. So you're stuck with kind of the worst of both worlds. So with regard to transfer pricing, obviously, right, there's going to be a substantial amount of reporting and record keeping that you have to do. The IRS is going to require this. And as I have here, right, it's required of a U.S. company that has at least one foreign shareholder with a 25% interest in that company and engages in transactions with that shareholder. Further, Form 4572, this has to be filed each year for each related party with whom the company had transactions during the year. And then finally, as I have here, the U.S. Treasury Department, based on the OECD guidance, they're going to require annual country-by-country reports to be filed by U.S. companies along with their annual income tax return. So the final point we're going to talk about here would be an advanced pricing agreement. So let's say that you just listened to this whole lecture, right? You say, I know the transfer pricing is a big deal and I need to set these prices appropriately. Now, your client is coming to you and they're saying, we really want to try to minimize taxes. And we want to set up the deal in such a way, this is a really, really large deal. So even 1 penny in price difference is going to make a lot of different outcomes here. So they're really trying to push the envelope to you. And you're saying, I think we could do that. That's probably reasonable. We could get away with that. I think that makes sense. But essentially what would happen is if they keep pushing you, right, and you get in a position where you feel uncomfortable or uncertain, obviously, right, there's professional ethics that you have to follow. You can't ever do anything that's like tax evasion, right? But what the IRS does is they basically say, hey, right, we are aware these situations exist. Maybe there's uncertainty, there's not really a good open market. If you have a big transaction between companies that you are having difficulty with establishing a price, you should complete an advanced pricing agreement. So this is an agreement between a company and the IRS to apply an agreed upon price, transfer price to specific transactions. If entered into and the company uses it, then the IRS cannot reassess that price. It's basically going to the IRS first and saying, is this okay? Now, these are really reserved for large, important transactions. They take a lot of time, for example, multiple years. And they can be unilateral, that is to say, between us and the IRS, or they can be bilateral. The IRS and the foreign tax authority could sign off on it. 5 phases to it. Not as concerned about that. Application, due diligence, analysis, agreement, drafting. And as I've indicated here, other countries also have their own kind of version of an APA where you can work with them. So it's kind of like if you were unsure about sitting for the CPA exam, whether you had the appropriate credits for it, there's an evaluation service where you can send things in and they will work with you up front so that when you apply, you don't get dinged and you're not allowed to sit. In the same way, with these APA agreements, what they essentially are is, hey, come to us, the IRS, and work with us up front, and that way we will make sure that you don't get dinged on the back end and we reassess you here. So with that, we're going to finish the chapter here on transfer pricing, chapter 9.